Hi everyone, this is the 17th of October 2024. A very interesting day because this is exactly 10 days after the 7th of October when you got the panic low in the market at 24,694. Now, why is this important from a 10-day perspective? Because this is the result season and we've actually seen markets stay under pressure during the last quarterly result season as well, which was during the month of August, right? So when those results were actually coming out, we saw the market react negatively into that month, and the market actually sold off into the 4th of August and then remained down and under pressure till the 14th of August. So that is why it was a very interesting period, and 4th to 14th was again exactly 10 days. And that is why I mention it, because when you think of technicals, you look at structure, you look for similarities from something that has happened in the past, but there are also differences. For example, at that point of time, the sell-off on the 14th of August did not fall below 61% retracement of the bounce, the small little bounce that we saw in the early part of August. However, this time round, today, we broke every level. First, we broke 61, then we broke 78%, and then we are almost close to making a double bottom. Are we going to make a double bottom or not? So that's the big question. And let me come to that by circling around, where we are in the overall scheme of things when we talk about the markets. Now, where are we? Since I started talking about the earnings season, this is the second earnings season, that is earnings period, that is expected to be poor by most analysts and most of the market community because of the post-election effect. During the elections, to some degree, government spending had slowed down, although they've budgeted pretty well for this year at least to grow the capex by 10% and so on. But that is a phase in which government action does slow down, and the hope is that it will probably pick up, and in the second half you will see that momentum come back. The other one is globally liquidity is expanding as increasingly various central banks start lowering interest rates. So the US has already moved in that direction. We are seeing Europe do that. They cut the ECB cut 25 basis points today, and we've already seen Japan's after doing their one rate hike, which caused the yen carry trade fear in August and was behind that correction. They've sort of backed off from further rate hikes for the time being. And we've also seen the Bank of England act. We've seen various individual governments, some of the emerging markets take action on rate cuts, but India is still not sounding it out very clearly. There is some signature of the RBI turning dovish in the recent RBI meeting, some hope that they will be able to move in that direction, but nothing clearly mentioned or said. So they're leaving it to the data. They still want to watch a certain data points and finally take a decision on interest rates. But globally, we are moving towards a lower rate environment, and China, which was the last man in trouble, is also starting to stimulate all over again, though we can debate whether the size of the stimulus is good, bad, ugly, whatever. But the announcements were pretty significant to the degree that they caused an almost 50% run up in Chinese equities in a very short period of time. So this is the backdrop with which the markets are operating, that global liquidity is likely to expand, interest rates are likely to go down. And India, within all of that, is at a point where, because we've not acted on the interest rate front, and second, because we are still going through a second quarter of poor earnings, our market is coming under pressure. Having said that, just a while back we were at an all-time high, so to that extent we can say, well, was there really pressure or not? So we can take a step back. As we headed into the month of September, what we really saw happening is, and this is where you learn something about market internals, right, is that you saw the mid-cap index or the broader market actually start underperforming the Nifty. So as the Nifty was rising through September, the broader market was not participating. And so when we look at indicators like the number of stocks above the 50-day moving average, there was a huge negative divergence in that indicator. So this is an indicator which we call a diffusion indicator. And if you're wondering where you really get it updated every day in real time during market hours also, it's on the Strike platform. If you've never used Strike, then simply go to web.strike.money and you can actually access the tools over there. Diffusion indicators and sentiment indicators are two of the most important tools, I think, from a market opinion taking point of view. When you want to really decide, is the market oversold, overbought, is it going to rise or fall from here? I always combine my Elliott wave analysis, my theories, with a look at the sentiment and diffusion indicators, because they tell you what the crowd or the masses are really thinking. Are they getting excessively bearish or excessively bullish? And that's why that's a very, very important tool set to have on your side. So do check that out. And that was indicating a negative divergence at the end of September. Now you finally saw that correction kick in October from that negative divergence. But what we are really seeing now, after we've seen the sell-off in early October until the 7th of October, and we're trying to bounce back, what you're actually seeing is that the broad market is now doing much better than the Nifty itself. In fact, today's sell-off, which was pretty steep, you've actually seen the mid and small cap indices hold up much, much higher. The small cap index being the best because it's not even gone back below the 20-day average in the selling today. The others have fallen below that, in fact, and Nifty itself has not even gone above the 40-day average. So that's the divergence we're actually seeing, a reverse divergence between these segments, where the broad market was weaker in September. The broad market is actually stronger in the month of October, which actually is completely opposite. So if the weakness in the broad market was a signature of a potential sell-off in the market, then I think the strength of the broad market should also be a sign of strength in the Nifty eventually. Right, it doesn't happen on day one, but eventually, if a divergence consistently remains in place, then you do see the markets move in that direction. And that is something that I would hope for, especially after today's reading of 0.65 on the Nifty put call ratio. So that means that a very large amount of calls, got purchased or sold as the market fell. I actually say sold rather than purchased, because rising open interest means both, but it's the writers who sell heavily when the market falls and try to earn that premium. And therefore, if writers are really selling so many call options on the way down, then I take that as a sign that a lot of shorts have actually gotten built into the system. And that creates room for a short covering, bounce back. Now, even FI is right now a short by around 1,80,000 contracts. So historically, the bottom end for shorts is around 2,50,000 contracts. We haven't seen it reach that extreme, but we have seen shorts get added on the institutional side. So that's another indicator of, the potential for a counter trend reversal, but it's the earnings season that is really bogging the market down, despite many near-term indicators that were beginning to get oversold, and the Nifty PCR being one of them. So now this low reading of 0.65 on the Nifty PCR is actually the lowest that we've seen since probably May, but actually the lowest since all the way back to June 2022. So imagine that the reading we are seeing right now is the lowest since the Nifty was at 15,200 in June of 22, when it sold off over several months in the midst of the Russian war, and then after that the subsequent interest rate hike risks from the United States itself that were kicking in, and that caused our market to fall that far. And that's when the put call ratio fell to 0.6. It hasn't gone below that ever since. In fact, most of the time it just gets to 0.66 or 0.667. The market really bounces back. So now that we've fallen to 0.65, it's actually a new low reading that we are seeing right now. So in other words, if the market does pause and hold up from here, then it would be a good sign for a potential trend reversal also in the market from the selling that we've recently seen. In fact, what I also find interesting is that because of rotation, some of the weak segments of the market have actually been through a decent correction, especially say defense stocks. So defense was a sector that a lot of people were touting as overvalued, overbought, gone up too far, gone up too fast. And now we've actually seen a good 60% retracement of the last rally in the recent correction. Various companies, for example, Hindustan Aeronautics or, Garden Reach have actually come back to the weekly averages, the 40-week average, and actually trying to take support there. And that's a very interesting level to really watch. So now that they've seen this kind of a correction, they're out of those overbought readings that we are seeing on the RSI, maybe on a monthly or a weekly chart. So all this has happened while the market was still trying to head higher and higher to 26,000. Individual stocks have done their corrections, and so we're actually starting to see signs of strength. And money also will chase. So you see, this whole talk about overvaluation, what does money really chase? Does it chase overvaluation or does it chase undervaluation? The truth is that in a bull market, as long as there is growth, the sectors that get overvalued, they continue to remain overvalued and continue to outperform because growth is still there. So unless you can really say that, no, this particular company stopped growing and it's gotten into trouble, that's the only time when those stocks will stop performing despite valuations. Otherwise, You may get valuation corrections from time to time, but eventually those stocks actually end up heading much higher if growth is still around. And so that is what we might witness once again, given that the most recent correction is not really breaking down weekly levels or long-term channels in this recent correction, and that means that the overall trend is still strong and remains intact. Still, stock-specific and sector-specific cycles can occur, which have occurred over the last 2 years. There are many stocks that have retraced 50-60% of their gains and then are attempting to pull back again. But I would like to chase performance because, like I said, that's what the market will also end up doing. Most of the money will chase growth despite high valuations, or it will chase undervalued stocks. Okay. Now, undervalued stocks can remain beaten down if a bear market shows up. But if it doesn't, then money can actually go there because we have a lot of liquidity coming into the market, and people who are concerned about valuations will look for value, which is exactly what drove up PSU stocks a year back from today. So which sector actually fits that bill right now? And the truth is that sector is financials, and specifically it's private banks and NBFCs. These are the two segments which have been consistently growing earnings at 20-30% year after year. But because of the over ownership of these sectors between foreign institutional investors who've been consistent sellers, in fact, the biggest monthly selling they've done this month in October, almost 68,000 crores worth of selling so far, and the month is not even over. So it's like almost like a record for the year, or I don't know for how many years, that they've sold so much in a month altogether. And since they are the major holders of that particular sector, that's where a lot of selling also ended up showing up. So banking stocks have been in a long duration consolidation despite growth, and that has caused their valuations to end up at the lowest level in years. And that is why that is a segment that can attract a lot of capital as long as there is no bubble popping or any such major bear market event. Then money will simply find a home, and one place that it can find a home is banking and NBFC stocks, which are undervalued. So that's also an interesting sector to watch out for. So I've spoken about two different things that happen as long as a bull market is in force. One is that you can actually chase value, and especially this is a segment where you have value and growth both. And on the other side, you can actually chase overvalued stocks that are already recognized and are growing. So both things can happen, and both things do happen during bull markets, and that is why you must pay attention to both potential, both possibilities. What is interesting is that if tomorrow, which is the weekly closing, we actually end up holding, 24694. That's the 20-week average that's the most recent low. The 20-week average is slightly below that, so we actually end up holding the 20-week average for the Nifty. That would be a very good sign. We did take support on the 20-week average for the mid-cap, small-cap Nifty 500 indices. The Bank Nifty actually closed below it, creating some sign of a potential, bearish outcome. But if you actually look at it even today, Bank Nifty is at a much higher level than the Nifty itself. So to that extent, it is outperforming, even though on a weekly averages basis, you may say, oh, well, it's below the weekly average. So I think the weakest link between these indices appears to be the Nifty itself. And it's getting bogged down essentially by companies that are not doing well in the earnings season. Like, for example, today it was Bajaj Auto, and that sort of drove the entire auto sector to take a knock. And that hit the Nifty pretty significantly. So it was not exactly across the board selling. Like I said, the mid and small cap indices did sell off, but broadly held gains. Stocks did not collapse altogether, as you would say if you were in a extremely bearish set of mind. In fact, even if I look at volumes on the downside were not very, very high overall at the Nifty level. And that means that it was not widespread selling or panic in the markets. And it was extremely concentrated selling, maybe in some areas, that caused the index to come down. And if all of this is true, then these oversold readings that I spoke of, the Nifty PCR or the short positioning, that should eventually play out in driving the markets higher from here. So that is the setup as we are getting to the second half of October. Completely the opposite expectation of what I would have thought at the start of September. For those who've been hearing me for a while, at the start of September, I was talking about the market going up and then selling off post FOMC, and then it did sell off in the earlier part of September before making that rally into the FOMC meeting. And then I thought October would be a weak month because of seasonality and various issues globally, because globally pre-US elections the US markets actually go down. Now, we did get a correction in India, but it was not because of global markets. Global markets have actually held out much better and gone to new highs. The Nasdaq crossed its previous highs yesterday. Before that, the Dow has already done that. The S&P did that next, and so that's been the cue. But even better, you have seen the US Russell 2000 and the bank index, both of them break out to new highs again, which is on the back of expectations that interest rates will continue to head lower in the US. And those two segments which were extremely weak on the rate cycle are beginning to perform. So that's a very, very positive, outlook that you're getting if you simply look at global markets. But Indian markets, like I said, are not following through because we haven't given a clear signal on interest rates, and we continue to deal with what is a poor earning season. So this has been the disparity due to which our markets now, despite the October sell-off, which was sharper than global markets, is remaining down and under pressure. But on the other hand, when we look at sentiment indicators, we are starting to get a sense that markets are getting oversold, and which is why I would hope that they actually bounce back, hold these support levels, and the upward trend continues from here. So that's something I'm going to be watching out for the next 2 days, that these key levels that I spoke of end up holding, and if they do, then we can resume the upward journey. So that's my overall take of what has been happening, in the markets. A lot of fear and greed going around, but in the end, things seem to be working out, especially on the global stage. And in a couple of weeks, we will know the outcome of the US elections as well. So that uncertainty will be behind us. And if you actually listen to both the candidates, you'll hear they both plan to do various amounts of spending in different areas. Of course, they have different plans, but in general, they have spending plans that can be positive for the US economy. So that's another thing that will work out very, very positively, the impact of which would be seen in the post-election period, because typically you have seen post-election presidential rallies, as they call them. But the last 3 to 4 times before the presidential rally, we did see an October correction, and that has gone missing this time because of the interest rate cycle that came in because of the US central bank lowering rates, and that has created a fresh enthusiasm in the month of October, unlike what we would have seen prior to previous US elections. So that's the entire setup I've left you with. A lot of things to think about, but like I said, it's an oversold market. It could be due for a complete reversal to the upside, and that is what we'll be watching out for over the next couple of days. And until next time, if you want to stay up to date with my opinions and my views, I write every day at IndiaCharts Insiders. So you just simply go to www.indiacharts.com, join the Insiders Club subscription over there, or download the IndiaCharts app, and you can read my updates on a daily basis on the app, on email, or on the site itself. And don't miss the very, very interesting Weekend with IndiaCharts show, where we actually discuss not just the week gone by, but overall, where are we in the state of affairs across equities, commodities, currencies, global markets, and how they all link together. For that kind of an in-depth, 1 hour discussion on markets every Saturday, do join us on the Weekend with IndiaCharts. So that's all from me for this week, and see you all next time. Thank you.